Hello folks, Steve Lynch here with Discover Options here at Option View Systems. Welcome to this presentation of 3 different market timing reports for advanced options traders. This will be for Friday, the close of March 4th, getting ready for Monday's open on the 7th. Presented materials for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get going, wanted to make sure that you know you have access to this ebook, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. If you want a copy, just simply get a hold of Option View and at the Discover Options office, and I'll give you that number right at the end here, okay? All right, all 3 market timing reports look at the current market condition in the SPX. The current market condition is defined in 3 different dimensions: price action, trend, and the stochastic status. In terms of price action, Friday was an upswing bar following Thursday's, that should say downswing bar. I'm just going to change that right now. That was a downswing bar. Very good. Okay, we have this upswing bar following the downswing bar on Thursday. We are underneath the 50-day simple moving average. And, boy, I did not get this. And we are actually between 15 and 55. Okay, you can see here, we're right at about 36 right here. And we are above that moving average, the percent D. So this is the stochastic situation. All sum total of these dimensions brings us to a market condition that has existed about 80 times since January of the year 2000. Only 80 times since 2000. And the big filter here is because we are underneath the 50-day simple moving average. Most of that time, the market's been above the 50-day simple moving average, but definitely you have a market environment that's much different underneath the 50-day simple moving average. So we have this price action and stochastic situation underneath the 50 happening 80 times since Jan of 2000. With that information, let's go to the first report, the Condor and Butterfly timing report. All right, so we have had roughly 4,600 daily closes of the S&P 500 since Jan of 2000. Of those, 4,602 to be precise, 64.6% of the bars have been favorable for selling options premium, all right, for Condor and Butterfly type traders, market neutral premium selling, because the actual 21 bar subsequent movement turned out to have been less than what the option prices were implying through their time premium. We look at the skew adjusted VIX to determine that, and indeed, not quite 2/3 of the time, all right, that the market turns out to be a favorable one for selling premium using butterflies and condors, 64.6% of the time. Now, also during that time, our current condition has occurred, as I said, 80 times. Now, of those 80 times, 50% of the bars were similarly favorable for premium selling. Half the time, they're not favorable. Not favorable, and that's a lot less than the 64.6 baseline. So we have then a theoretical selling edge that's negative 14.6%. Statistically, it's more likely than usual that the current market condition that we just expressed here will end up being an unfavorable one for market neutral option premium selling. Is that a guarantee you'd lose money by using those strategies? No. Half the time it works out okay. But you can also have an adjustment approach that weathers the storms very well. But at least you know that it's more that this market condition, more often than usually leads to an environment that makes for some rough waters for the Condor and Butterfly traders. With that in mind, let's go to the next report, the bull put spread timing report. This is for those that sell put premium using credit spreads, naked puts, maybe hedged bull put spreads in the S&P 500, roughly 30 days out, selling premium roughly a standard deviation away. Okay, so in that case, As I expressed, we've had 4,602 daily closes of the S&P since Jan of 2000. Of those, 82.7% of the bars have been favorable for selling put premium like this, where the actual 21 bar downside movement going at those puts, going down, on the downside movement was less than what the SIBO skew adjusted implied movement to the downside was. Okay, so the SIBO's, the VIX, the SIBO's published VIX value, when it's adjusted for the skew, implies a certain downside move through the option prices. 82.7% of the time, the market does not move down that far. Okay, it does not move down that far. The rest of the time, what would it be? Roughly 17.3% of the time, it does move down and hit that one standard deviation level to the downside. Now, let's go to our market condition here that occurred 80 times. Of our 80 times, 80 occurrences, 71.2% of the bars were similarly favorable. That's a lot less than the 82.7. Okay, so this implies a selling edge, a put selling edge of minus 11.4. Statistically, it's more likely than usual that this market condition will end up being an unfavorable one for selling out of the money put premium in that fashion. Okay, finally, let's get to the market likelihood report. And what we do here is we look at the rate of change, 5, 10, and 15-day average rate of change over the course of those 4,600 occurrences since Jan of 2000. So let's go to the top line here. Okay, and we could see 4,605 occurrences of the S&P 500 since Jan of 2000. Okay, from one close to the close 5 days later, the close 5 bars later, on average, we have a change of almost 0.1%, 0.09. Remember, the market's been very bullish most of the time. We've had some bear markets in there, but generally the market has gone up quite a bit. On average, you have a 5-day rate of change of almost 0.1%. The 2-week rate of change, 10 bars, 0.19, almost 0.1%. The 3-week rate of change is at 0.28, just over 0.25% to the upside over the course of 3 weeks, and that's on average. Okay, now let's go to our 80 occurrences, which constitutes roughly 1.7% of the sample, of the total population we have. And of those 80, the average 5-day rate of change is going to the downside 0.15%. Look at that. So instead of going up 0.1% almost, it goes down 0.15%. 0.15%. The 10-day change is it down to minus 0.28%. The 15-day, look at that, is at 0.01. It levels out and doesn't go down as much. Very interesting. How significant are these changes going to the downside? Okay, so in the 5-day one, instead of going up an average of 0.09 like the baseline, it goes, of these 80, it goes down 0.15. That's a difference of 0.25, 0.25% on average. Okay, when you look at how significant that is, we use something called z-scores. And this basically tells you the percentage of a standard deviation reflected by this change. In this case, that 0.25 of a difference is it's not even 1/3 of a standard deviation to the downside. Okay, it's not that significant. All right, it's now if it were a full standard deviation to the downside, then we'd be talking, or maybe something even over half, but it's not. The 2-week change, the z-score, is at 0.41, not even half a standard deviation to the downside, and the 3-week one is at 0.21 of a standard deviation to the downside. Not hugely significant. Now, what I like to do is carve this up to reflect the notion that We just want to know where the rates of change would be if the market goes above Friday's high, come on Monday, or if it goes down below Friday's low. And in those instances, of those 80 instances, the market exceeded the high of the day 55% of the time, or excuse me, 55 out of the 80. Okay, and it exceeded the low on Friday 18 times out of 80. Okay, there are roughly, roughly 8 inside bars of those or so. So you can see here the z-scores of the 55 when they exceed Friday's high. Okay, 0.41 on the downside, tiny bit, 0.03%, 0.41 of a standard deviation, 0.03 of a standard deviation, that's really, really small, and then basically 1/5 of a standard deviation to the upside. Okay, not even a half a standard deviation in either way. Now here's the kicker: if somehow the market reverses course and exceeds the low on Friday, now you have changes that are much different on the downside. Wow, I mean, the market really tanks in the case that it goes down below the Friday's low. The z-scores, look at 2 standard deviations to the downside, 1.8, almost 2 standard deviations, and then the 3-week is at almost a full standard deviation to the downside. So that's the thing to watch, is if the market somehow reverses course and exceeds Friday's low. I mean, that'd be a huge swing. You're looking at huge bearishness then, okay? So all in all, okay, directionally, can we really hang our hat on anything? Not too much, unless the market reverses course and goes down a huge amount on tomorrow on Monday. In terms of volatility for us option traders, the baseline realized volatility of the market is in the about 15.5 to 16%. Our current market condition results in realized volatility of around 21%. That's much higher than the baseline. Now let's come down and look at the VIX. The 9-day VIX annualized at 13.86. The 30-day VIX is annualized at 14.77. This structure is where the short term is lower than the long term. That's bullish in and of itself. The market's, the option traders are making this bias. This is a structure that you would expect in a more bullish environment. If this was inverted, if the short term was higher than the long term, well, that would be bearish. And so this is a bullish indication here, but still, and it's quite a bit lower than what the realized volatilities are from these 80 occurrences in the past. Very interesting there. So for premium neutral traders, or excuse me, delta neutral traders, kind of rough, given that the realized volatilities are much higher than what the VIX is saying here. Okay, I hope this has been helpful. Again, thanks so much for joining us. I'm Steve Lentz with Discover Options. Thanks for joining us. We'll talk to you next time. Good luck trading this week. Bye-bye.